For anybody who's seen those dollar signs go up and down with recessions and bear markets, today's video is for you. We'll be sharing 3 strategies on how to cope.
Hello Firestarters, I'm Matt.
And I'm Matt.
And we're Matt's on Fire. If you're new to our channel, we are boggleheads, foodies, and adventurous aspiring fire.
And today, we're going to talk about the strategies we implement every time we face a market correction or bear market.
Before we start, please smash the like button and subscribe to our channel to help it grow. So Matt, do you remember our first market correction together?
Vaguely.
I think it was during the Brexit referendum in June of 2016, and we just finished doing a ropes course with our friends.
Now that I remember because I love doing ropes courses.
The market at that time was dropping about 3% per day, and I was really panicking. So
he was in a state. So you might be wondering, what is a correction? A market decline of more than 10%. And a bear market? That's a decline of more than 20%. And just a fun fact for you, in your investing career, you'll probably encounter 60 corrections and 17 bear markets, somewhere around there. A very important thing to remember when you're investing is how you behave. It matters a lot, especially during a market downturn, because that's when everyone's emotions gets high. If you panic during a bear market, you might sell at a loss, which is the worst thing you can do as an investor.
Keep in mind that you are investing for the long term. So short-term market fluctuation should not matter. In the long run, the stock market always goes up. For example, the March 2020 crash was just a small blip in the grand scheme of things.
But not everyone has the same risk tolerance. People who are experiencing their first bear market might bail out, while other seasoned investors will see an opportunity, like us. So what should an investor do? We have 3 things to suggest for.
The first strategy is to ignore market noise. When there's a market downturn, the media and some popular personalities on social media will highlight how the average portfolio is taking a hit, and it'll wake the fear of loss inside you. It'll be very tempting to check in constantly on how your portfolio is doing and react somehow to what's happening around you. Don't do it. Even when you watch news on TV or online, listen to the radio, or read the latest headlines from news companies or social media personalities, stay the course with your investment portfolio and ignore market noise.
The second strategy is sticking with your investment plan and asset allocation. For example, if your ideal asset allocation is 90% stocks and then 10% bonds, and a bear market occurs such as your asset allocation is now 70% stock and 30% bonds, you buy enough stocks to get back to your original asset allocation of 90% stocks and 10% bonds. This way, it forces you to buy low.
The third strategy is tax loss harvesting. And this is something you can do when the market downturns. And it gives you kind of an outlet and an effective way to save money. It turns lemons into lemonade.
I love lemonade.
So tax loss harvesting is basically selling investments that are down. It replaces them with a reasonably similar investment and then offsets any gains you have that year with those losses.
For example, if we bought $5,000 worth of a total stock market index fund, such as BTSAX, then the market tanked the next day such that your initial $5,000 is now worth $1,000. You sell that and buy a highly correlated fund such as an S&P 500 index fund, VFIAX for example. And by doing that, you now lock in a loss of about $4,000.
And at first glance, that $4,000 loss may sound like a bad thing. The key here is to understand how market valuation works. We basically have taken dollars in cost per share from one fund and replaced it with those same cost per share in a different, very similar fund. That then creates a loss in terms of how the IRS tracks the market. And we can then use that to offset gains and create a tax deduction of up to $3,000 per year. Any unused deductions that we have also carry over to following years every time we do a tax return. It's a very effective strategy to save cash.
So far in 2020, we harvested a loss of approximately $100,000. That is equal to a deduction of $3,000 per year for 34 years.
That's almost as old as we are, isn't it?
That's right. We can also use that losses to offset any capital gains in the future. I believe it is the best psychological hack that we have ever discovered.
Which is good for any marriage. So there you have it. These are the strategies we use to invest in a correction or a bear market. If you have questions or tips, please share in the comments and we'll get back to you as soon as we can. Thanks for watching.
Before we let you go, Matt and I wanted to summarize our 3 recommended strategies. Number 1 is to ignore market noise. It'll be really tempting to avoid loss by anticipating or reacting to what's happening. Check those emotions. Number 2, stick with your investment plan and maintain your asset allocation. That naturally causes you to sell high and buy low. Third, tax loss harvest to offset future gains with current losses. And above all, stay the course, which sounds easier than it is. Thanks again, and see you next week. This is Matt's on Fire.